Yeah, this is where the action is. There's no question about it. We've had the explosion in the stock market over the last couple of weeks. We've had the total collapse of the bond market. We've had tons of action there, and we're going to see more action in both of those. But I believe that the place where the biggest action is going to be is in the dollar. This chart shows the dollar back to 2002. You can see the big bear market back from 2002 to 2008, where the dollar index, which is a basket, it's like the Dow Jones of currencies, went from 120 down to 71. That's a monster bear market. Now look at the consolidation that we've been in now since the early part of 2015. We had a big bull market in the dollar in 2014, and we've been doing nothing ever since then. Well, the dollar started to move once we had the election, and actually before that, you can see now that we're at the breakout level of the congestion here. If we break above that 100.71, I'm looking for the dollar to move up by 20%. This would be one of the biggest bull markets around. 20% in a currency is a huge number. Now, how can you play it? Well, there's ETFs you can play it. You can open up retail Forex accounts. You can use Forex futures. So there's many ways that you can play this. Options on the ETFs. Lots of ways to play it just explicitly. There's also implicit ways of playing it, because if the dollar's strong, probably means gold is going to be weak, but we'll get into more of that later. But this is where the big action is. We've already had great action in the stock market. We're going to continue to have it there. In particular, I think we're into a major bear market in bonds. This is the next place where the action's going to be. Hey, let's dive right in. I'm Courtney Smith. This is TradeSmith, your weekly video newsletter. This is the disclaimer which we have to put on everything, just so you know. Who knows what's going to happen? And you know what? Trading is risky. Now, I hope you knew that already before you read this, but okay. All right, now, let's take a look at the S&P 500. Now, this is why I think it's going to calm down a little bit. Couple things. We've had a great explosion here. I think the explosion is over. You can see we're back up to the old highs on the S&P. You can also see that the purple predictor is not confirming the bull move. So we're seeing the price go up, the purple predictor going sideways. Purple predictor usually wins that battle. And so I think that what's going to happen is we're up to the old highs. There's going to be a lot of selling up there, and this market's going to sell off. Now, it's only going to sell off a little bit, set up a little bit of a consolidation range, maybe 2165, 2170. I don't even think we'll get down to 2150. And the highs that we just made on Friday, 2190, somewhere in that area. So look for consolidation. So this is not going to be where the action is, all right? Yes, I'm still long-term bullish. There's lots of really bullish things. We'll get into those in just, well, how about we get into them right now? Okay, Dow Jones, same thing, except this one's already made a new high, but you can see it's already staggering here. Now, also notice that the purple predictor is kind of confirming the price action, but it's way below the price action. That makes me very nervous. Once again, the purple predictor usually wins these battles. Now let's tear apart the Nasdaq, okay? The Nasdaq finally became the leader in the market in the last week. Let's go back up. Dow Jones sideways for the last week, but the Nasdaq moved higher. But let's take a look. First of all, notice that I've got a bunch of slanted lines, okay? So up at the top, I just put a red line showing the downtrend and then a red line showing the uptrend. Now look down at the bottom of the chart, and you can see that the volume was starting to move up in the down moves, and it's moving down on the up moves. So that's not a good sign for this bull market. Once again, it shows me that the market's running out of gas here. Yeah, let's put it that way. Also, the red arrow pointing to the purple predictor. Purple predictor, once again, I mean, it's just not confirming this price action. So I really think this resistance, the purple predictor, are all signs that we're going to get a setback in the market. So look for weaker prices this week, okay? Now, I'm not saying it's the end of the bull market, but look for weaker prices this week. Seasonality is wildly bullish. And that's why one reason why I just don't think we're going to have any type of a major setback at all. 1 or 2%, that's all. No big deal. Just a little normal correction in an explosive bull market. Seasonality patterns, let's just double check here. Here we are in November. Now we're getting kind of towards the end of November, but you'll notice in all of the charts, there's a dip in early December. There's a dip in early December. Well, guess what? There's no reason why that dip can't come a little bit earlier. Now, normally the week of Thanksgiving, which we're going into, is a very bullish week for the market. So, look, all my indicators tell me that we should be selling off this week, get a little normal correction, but maybe the market will use its normal seasonality and will trade higher till the end of the week. And then we'll sell off, but we'll sell off a little bit more, maybe 2 or 3%, maybe 4% in the market, not any longer than that. So according to these seasonal patterns, we might have to wait a week before my predicted correction occurs. Yield curve, nothing here, except look at the far right-hand chart. That just shows the end of next year is going to be, the fourth quarter of next year is going to be very, very bullish. Asset allocation, wildly bullish. Really, this is a dramatic move that we're seeing here, and that's highly supportive of the stock market. Guess what? The market wants to take all the risk it can. It's saying, come on, let's go, let's go, let's go. Let's rock and roll. And so people are shifting out of the conservative, defensive sectors like utilities and consumer staples, and they're moving into wild and crazy stuff. Global shares, boring, except the Greek stock market, which is broken out. Now, I've been really bullish on this market. It's broken out again. I think it's time to take another shot at the long side. I really felt that the Greek stock market was going to be spectacular this week. We had a nice run earlier in the week. I think it's time for another run here. But one I have been pounding on for quite some time is this market here, the Japanese stock market. You've got to be long. This is going to continue to move higher. They're just going to keep on easing and easing and easing, and that money's going to go into Japanese shares. In addition, the Japanese central bank is now the largest buyer of Japanese shares. They ran out of Japanese bonds to buy, so they're quantitative easing. They're buying big cap stocks. And you know what? They're going to run out of those pretty soon. They're going to have to start buying mid cap stocks, and they're going to have to stand out on the street corner and hand out 20 yen, 1,000 yen notes. So be long Japanese shares. All right, now let me explain something to you. Up until a couple of weeks ago, I showed you EURUSD. Well, EURUSD is the Nikkei, but it includes the effect of the yen. Well, you can see up at the top of the chart, the yen has been collapsing as we told you it would. But you can see down at the bottom, the Nikkei is going up. Well, if you blend those two charts together, you end up with EURUSD, which has been drifting down because the yen has been going down more than the Nikkei's gone up. But by using DXJ, we don't care about the yen anymore. We're just focused on the Japanese market. So DXJ is where you need to be. Now, this shows you the difference. So what this is this is a chart of the one that I've been telling you to own, DXJ, for now a month or so, divided by EURUSD, the one I told you not to. And you can see, look at the difference. Since July, DXJ has significantly outperformed EURUSD, particularly here in November when the yen just fell off the edge of the table. All right? DXJ, be there or be square. The thing is going much, much higher. Bonds, whoa, have we made a ton of money here? I hope you're, please tell me you're short. Now, but here's the problem. I think this is another market where we're going to rally this week. Okay, we got a little bit of momentum divergence. You can see that the price made a lower low compared to 4 days before, but the RSI didn't. That's a little momentum divergence, usually good for 2 or 3 days to the upside. So look for that here this week, a little rebound in bonds, and then we'll reestablish the bear market. Key factors in the bond market. Mixed bag, one up, one down, one sideways. But the most important one is the blue line, which is the yield on the 10-year Treasury in Germany. And it's going up. It's showing higher interest rates. The green line is the U.S. interest rates. You can see it's just gone completely bonkers. Now, this is where the action is. Please, 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 I talked about that at the beginning of this broadcast. In particular, U.S. versus Euro, or Euro-US, is the place to be. Short Euro-US. Euro will be the weakest currency. They've got to continue to ease. Of course, yen will be very weak as well. But the euro, there's an existential threat that it may not exist. And so people are dumping euros like crazy because after Brexit, maybe there's going to be Frexit and Italexit and Portexit and Polexit. And I'm getting exited out of here. Okay, gold. If the dollar's strong, usually gold is weak. Certainly the case, much weaker than the dollar. I mean, look at this. This is a terrible looking chart. So got to be short gold. Gold bugs, go hide away for a little while longer. It's not time to buy. It will be time when inflation comes back next year. But right now, the strength in the dollar is going to crush inflation inside the United States. All right. Our indicators are all bearish, although the middle one, which is the CRB, has stabilized a bit, so it's not as bearish as it was a week or so ago. But the yen and the euro, which are the bottom and the top panels, very, very bearish. Oil got a bit of a rebound. I said if it broke that level. It did break at the level that we talked about last week, but just the one day. So we got a rebound here on ideas, once again, that OPEC might actually have an agreement where they will reduce or cap production. Once again, got to use these types of rumors, these types of ideas as selling opportunities, because I've been following OPEC since the early 1970s, and they have yet to actually follow through on a cap in production. Okay, hey, listen, so much activity here. If you're a freebie, we love having you here. But really, this is the time where this weekly market newsletter just pays for itself in specific recommendations. You don't get to see them. Our fully paid up members do. Please go to the website up at the top and subscribe so you too can make a bunch of money. All right, I'll see you next week, freebies. Fully paid up members, hang on just one second.